Well, let's quickly move on from India's macro data. Let's go back and talk about those US CPI numbers, which did, of course, offer a lot of relief to the street back there as well. James Knightley, Chief International Economist at ING, is with us now for some perspective. James, good morning. Great to have you on the show. Thanks for joining in. So I don't know, if this is a permanent relief or just a temporary relief, because the market has been roiled on these recession or stagflation fears, right? But at least the February data was all right. But then all the tariff and the counter tariffs and the retaliation, all that hasn't yet kicked in, at the ground level. So is the market's optimism on yesterday's inflation print, is it well placed?
Yeah, I'd characterize it as a bit of temporary relief. I think, the market had gone in expecting another relatively hot inflation print, but we got this 0.2, and that's what we really need to track out each month to deliver the Federal Reserve's target of 2% year-on-year inflation. We need consistent 0.2s. So a good number, but when we looked at the details, we saw that it was primarily or overwhelmingly due to a substantial 4% month-on-month drop in airline fares. Most other components still remain relatively sticky. So, yep, good number, but still a little bit of caution in terms of the outlook. And this is, of course, as you state, before we really see the impact from tariffs, because I think the Federal Reserve will be a little bit cautious because their own beige book, their own anecdotal survey of the state of the US economy reported that manufacturers and retailers themselves were also preemptively starting to raise prices ahead of tariffs kicking in. And we also had evidence yesterday, or 2 days ago, actually, from the small business sector, where we had a 10 percentage point jump in the proportion of small businesses already raising prices. Just because, of course, if you're doing long-term contracts, you've got to account for the risk that tariffs do kick in and put up your input costs.
All right. Hi, James. Good morning. Good to see you in. What does this mean for the Fed? The Fed futures are suggesting now that we could possibly get 3 rate cuts in this year. Do you think that's far-fetched? How many would you believe realistically? I recall when we chatted last, I think you were hinting that the first half of the year you're not seeing cuts. Maybe there could be some kind of probability we see some later in the year. What are you working with for 2025?
Yeah, I think that's still valid. I think, the expectation was at the start of this year that the economy was in a pretty good place and Donald Trump would come in and perhaps turbocharge that growth story with tax cuts and deregulation. Of course, he's not done that. He's actually introduced significant government austerity, i.e. government spending cuts, the people being laid off, etc., people losing their jobs. And also, of course, introduced this trade protectionism, which is causing some discomfort amongst both households and the corporate sector. Households are worried about higher prices. Companies are worried about squeezed profit margins from the higher input costs. So that is a headwind that's created more concern about the growth outlook. And while, yes, tariffs can cause near-term inflation, there is concern that downside risks to growth could depress inflation over the longer term. And that's really what the Fed is looking at. The Fed can't change inflation month to month, in the near term, but it can have an influence over the medium to longer term. So this growing concern that government austerity, trade tariffs can depress US economic activity is forcing or pushing the market in the direction of thinking, well, the Fed might need to do a little bit more. I would agree with that, but in the near term, we've still got an economy that's growing, we've still got an economy that's adding jobs, and inflation is still above target. So I stick to the view that we won't see anything before midsummer, late summer perhaps. But yes, I think we will see rate cuts in the second half of this year. And we're looking for September and December with a third cut coming through in March next year.
All right, so 2 cuts this year is what you are expecting. The third one comes in March next year itself. James, I just wanted to understand the other macro data point that came yesterday, and it is not inflation. This is the federal budget that was announced, and alongside that, we had the deficit in the US, which topped $1 trillion for the first time ever. With the Department of Government Efficiency, DOGE, coming in and all of that, with all that the Trump administration is doing, do you see this number coming down? If yes, by how much?
Yeah, it just highlights how much work they've got to do if they really do want to bring that deficit down. I mean, we're running a deficit in the United States of nearly 7% of GDP. That should not be happening when the economy is in such a good position. So it does highlight that there is scope for some significant cuts, and we think that those will continue. But it's going to be, as I say, as this data proves, it's going to be very, very tough. So what does it mean for markets? Well, I think there are lingering concerns about debt sustainability in the United States. And in an environment where the US is, with its robust viewpoints on trade and other things, geopolitics as well, is upsetting and alienating many other foreign countries. And we've got a key question: will foreigners keep buying US treasuries to the same extent that they have been? Will it put more pressure on domestic investors to step up and buy these treasury bonds to fund the US deficit? And if that is the case, then we could see buyers basically saying, well, we need more reward for the risk that we're running. And we do think that that does threaten higher treasury yields over the medium to longer term. So we'd still be looking for treasury yields, the 10-year treasury yield, for example, which has risen back up to about 4.3%, to push higher. We'd be targeting 4.5% in the near term, with the risk that we do on these debt sustainability concerns approach 5% at some point.
Oh, very, very interesting. And we're looking at big shifts, right? Big shifts in market behavior, investor behavior as well, all triggered by these tariffs. Thank you very much, James, for the perspective this morning. Really appreciate you being with us on the show.